Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, we are back on Friday, March 28th, and we got a bunch of stuff on regional pricing and tariffs and a whole lot of updates for global crude and gas. So I think maybe we start with some crude differential stuff. We both independently saw some interesting things on this week. You had some good points on your latest daily market update for Canada's differentials. Do you want to kick it off with that?
Yeah, I'll start out in North America and maybe make our way across the Atlantic into the Middle East. You know, one of our theses is, I don't think that's a word. I think I just made one up. Thesis? What is the word for plural thesis? I don't know. Okay, sorry. I derail. Back on track. Western Canadian diffs. The tariff excitement that started essentially as soon as President Trump took office had most believing that any tariffs applied to energy imports into the U.S., certainly a large portion of that, the majority being from Canada to the U.S., would be a pushback on barrels into Western Canada, and that the Western Canadian producer would bear the brunt of that political move. And here we stand today. While tariffs still haven't been implemented, go back and listen to one of the prior podcasts on the USMCA or just the ongoing delays. But for the time being, we've seen Western Canadian diffs improve materially. So, for example, Western Canadian Select trading at about minus $12. You know, that's a grade. Western Canadian Select at Hardesty will, often trade at minus 20. And the most recent history, just say in the last couple of months, right around the end of January, we're looking at a minus 18. So certainly seen some improvement. MSW, or a lighter Canadian grade, was around that excitement time of the Canadian producers going to really feel this. It's going to be painful for those folks. Minus $15 inside or near minus 10 recently. So that same sort of improvement. Now, we'll get to it a little bit later on today, I believe, with an upcoming deadline for actually implementing some tariffs. But so far, it is certainly not the Canadian producer that's been feeling that. And, staying on North America for a minute here, the similar trend has been seen with Mayan crude. So Mexico, another country which we have trade with involving the import of barrels of oil. There's some complications in, any analytical work on the flow of Mexican barrels to the U.S. simply because they've built a new refinery, which you've covered, I think, in great detail in some of the Energy Intel reports, the Dos Bocas refinery. But, late last year, a Mayan diff was, let's just call it minus 8.25, and we're currently inside of minus $7. So that has been a kind of straight up move beginning in mid-January. Yeah. I think it's, go ahead. Yeah, please.
Yeah. Kind of coinciding with the commercialization of Dos Bocas, because that's been a 3-year plus process where, you have a promise, in 6 months, it's going to be, ramping to full capacity. And so we're 3 years later. And I think this spring is finally the time for that. So it's kind of an interesting connection. One of the real quick questions before we continue on this, when you were talking about the Western Canada Select, one of the big topics when the Transmountain expansion project was coming online for May 2024 was that was going to have a pretty big impact on Canadian diffs. And I'd be curious to hear your thoughts on that, what actually ended up happening, if it was kind of just a non-event.
The flow of barrels on a different path, I think just logically speaking, you create another exit route. It should improve diffs. I mean, it's a kind of classic transport example of if you fill the new pathway with incremental production, then no, it shouldn't change anything. And, while I can't say unequivocally, I think just stepping back and looking at it from a distance, if diffs are improving and it's, the confusion becomes enhanced when you've got this tariff threat and the unknown of what goes where and what people have to pay to make it go where. Just logically speaking, I think you would look at the data and say, well, there must not be more incremental barrels than there are incremental pathways to new markets. It's a good tie. I guess put a pin in that, and we'll talk about Venezuela a little bit. But, along the western side of the Americas, the flow of crude is alive and well, a lot of it moving from South America or far North America into California, into refineries to meet a very large population. I think the question mark, and this is maybe a stopping point before we go back into diffs, a barrel of crude is worth less today, regardless of what, we cover today in terms of diffs. When you've got benchmark pricing, just generically speaking, down about $10 year over year, improvements in diffs, are certainly a nice sign for those that have become increasingly concerned that we are going to be definitively oversupplied. And I think the jury's still out on that. When you look at, U.S. and ARA crude stocks or the lagged OECD crude stock data, I don't think it's a foregone conclusion yet. And OPEC should have probably the greatest or the strongest finger on the pulse of the market. And if they're choosing to bring barrels back, I think there's something to that. Now, the counter argument is, well, it's just time for a price war. No more market share for anyone else. And, we'll see. But, right now, diff behavior, while we've certainly seen a degradation at the front of both the Brent and the TI curve, we've leveled off. I mean, this is many days in a row now where you've got mid to high 60s TI and, high 60, low 70 Brent. And we're just kind of hanging out. I think we're in a wait and see environment.
Yeah. One of the interesting diff kind of segments of the market that I've been watching has been Guyana. And we've talked about Guyana's planned production for 2025. We have another 250,000 barrels a day coming online by the end of the year from the Yellowtail project, currently running about 650,000 for the last 5 months or so. One of the interesting price dynamics, though, has been Guyana's Payara Gold, which they brought online with the Prosperity FPSO in November of 23 and ramped that up pretty quickly to 250,000 barrels a day. But pricing wise, that's, Guyana's heaviest barrel. It's 28-degree API. And the dynamics between Guyana and Canada, I think, is pretty interesting because Pad 5 has been the primary buyer of that Payara Gold within the U.S. And as the tariff commentary really kicked off in January, we saw Payara Gold jump to a pretty rare premium against Brent. And then as the USMCA and rules of origin commentary and each delay to those implemented tariffs came about, that premium just faded again and has eased into a discount again. So I think that maybe that is, to me at least, a signal of repricing tariff expectations and saying, hey, I don't know if they're actually going to go forward with putting these tariffs on Canadian crude, which for the Pad 5 buyer, I think that really is just kind of that conversation between TMX pipeline, which, as I said earlier, came online in May 2024. That pushed out a lot of Guyanese crude. So I think maybe now they're expecting a little bit more competition. So,
and then there's some other interesting new news. Like, I don't know how this ends up impacting, well, I guess the entire world, but thinking about the flow of barrels from Western Canada, TMX deliveries onto a boat down to the West Coast, or Guyana's barrels through the Panama Canal up that way. Are they on a Chinese ship? This idea that we're, the
$1 million
U.S. is going to go after, million and a half port entry fee if it's a Chinese built ship. And based on everything I've read, it sounds like, well, all the ships are Chinese at this point.
Yeah.
And then I guess one other thing I was like, on the point you're making there about, what Pad 5 is buying, their preference for a Canadian barrel or a Guyanese barrel, single point of exit, when you're buying from a market that has, a more developed shipping pathway, whether that be the number of boats in the vicinity, the port itself, you're less subject to these momentary disruptions. If I'm buying from one seller at one point, they have a hiccup, then all of a sudden you get this price spike that can disappear just as fast as it showed up. And I don't know that has really anything to do with it, but it's just an interesting, I guess, reference point of, if I'm buying from Guyana versus buying from Venezuela or the Middle East, I'm kind of buying from a new kid on the block. And, there can be a problem, or vice versa. Buying a TMX barrel, that's still pretty new. Things go wrong often when things first start up.
Yeah. Pad 5 is interesting to watch their mix of import origins to see, Brazil has really ramped up in the latter half of 2024. Colombia was in there, and Iraq. So it seems like there's maybe some alternatives that would ease, any near-term disruption. I think it's also important to mention the TMX pipeline's 890,000 barrels a day versus existing pipeline capacity to the Midwest at, over 3, and that's fully filled. So relatively not as significant. On that Midwest note, I think the interesting connection is looking at Pad 2 product stocks and crude stocks.
Yeah. I mean, one might have thought with all of this tariff excitement that Pad 2 would have been trying to get itself chock full of Western Canadian crude as fast as it could so as to get it in before the deadline. And lo and behold, Pad 2 crude stocks are essentially the exclusive driver of the current year-over-year crude deficit for the overall U.S. The total U.S. crude inventory deficit as of the latest data released on Wednesday, March 26, was minus 14.6 million barrels year over year. And 100% of that is from Pad 2, who has crude stocks at the bottom of the 5-year range, and its nearby neighbor, more an export-driven market than an import-driven market, although there is certainly still a greater inflow than outflow, but we know all the incremental barrels have to leave through Pad 3, in incremental barrels of production, that is. Pad 3 crude stocks are just kind of right on top of last year, right in the middle of the 5-year range. And it's, the much smaller Pad 2. So for some context, at this current moment, Pad 3 crude stocks at, let's just call it 245 million barrels, round number. That's 140 million barrels more than Pad 2 has. Pad 3 is a much larger pad district than Pad 2. But it's really interesting to me to see that. And then, I don't know, maybe you give us a rundown on product stocks and what's going on in that same pad.
Yeah, I think we kind of talked about this a few weeks ago, but seeing the refinery runs to start 2025, talked about, building up those product inventories ahead of potential tariffs, but seeing Pad 2 products, shoot up beginning February 7th-ish, but last few weeks for total gasoline stocks holding above the 5-year seasonal range, and this week at about 58.2 million barrels. Distillate I think is even more impressive. Also kicking off in that first, second week of February and have held above the 5-year range since. You're at 32.8 million barrels for distillates. That's versus 31.8. So about 1 million barrels higher year over year and versus a 5-year seasonal average of 29.9. So those have jumped. And yeah, we were discussing this a little bit before we got on here, but what kind of buffer that gives Pad 2 with any potential, tariff related disruption if that were to happen. And the number that we came out with was about 30 days of supply, roughly, incrementally, I guess.
It'd be interesting to see who is the benefactor of that buffer. In theory, the Midwestern refiner could say, well, hey, I have to buy this more expensive crude now, so you have to pay more for my product. I'm just passing that cost along. Mm-hmm. Well, only like in the beginning with product stock so high, that could just be extra margin for the refiner who is actually not bringing in, the extra barrels. So I think that relationship of, 5-year low crude stocks, 5-year high product stocks, it's nice in the US where you get these clean weekly data points. The focus on Pad 2 will be really, I think, a topical point for the next several months.
For sure.
And then I guess the last topic on Pad 2, just really drilling down into where specifically in Pad 2, the low crude inventory is almost exclusively at Cushing. Mm-hmm. And for some context, we talked about earlier the overall Pad 2 crude stock level of around 105 million barrels. Cushing stocks, 22.7. So let's just call it a quarter of Pad 2 is held at Cushing. When Pad 2 has been its most full, Pad 2 crude stocks can get up near 150 million barrels. And when Cushing is been at its fullest, let's just call it 60 million barrels. So, that ratio can change, certainly. Yeah. And with Cushing being the NYMEX benchmark price point, I think there is something interesting there. So 22.7 million barrels at, call it the end of March, late March, is the lowest reading for Cushing going back to March of 2009. That's not new. You and I both have talked about that in various pieces that we've written up, how low Cushing stocks have been. And I would say the theme the market has really moved towards is Cushing is just not relevant. It's might as well be a mix of pipeline interconnects rather than a true storage hub that we should be pricing our crude off of. There are efforts to try to move that to a Houston market since we're really a export-import driven country. And then, those fail. There's all kinds of challenges with, legacy derivatives and how do those get repriced and what do you do? So, same thing is even discussed about Henry Hub and the gas market. But I think that the relevance here is Cushing stocks are very low. And if that doesn't change, could we actually have a near-term price spike that is unexpected for a market that's taken on a really en masse view to believe, well, there's no way we go back to the mid-70s? Could this little old storage location that, the market wants to forget about all of a sudden drive a rally? And whether it be, as pronounced as we think it could be in flat price, is it a curve shape situation? Like there's another interesting context when you look at where the flat price levels are and the Cal strip shape. The curve's gotten a lot flatter. The TI curve, a buck or two between Cal strips, pretty flat, with this general idea that $65 a barrel or lower doesn't work for any incremental production out of North America. Yet you've got a June spread, June, or, front June versus 1 June out, and December versus 1 December out. Typical spec trades. And the June at, plus $4 is not really all that bearish at all. If anything, it would kind of lean to the bullish side historically. Mm-hmm. You go back and find other periods in the shale era where the back of the curve went to the replacement cost of a barrel, and you would have a spread such as a front June often trade at plus $2 or even plus $1. So there's, this kind of dichotomy between the way Cal strips are trading. And I think that becomes a function of the supply of derivatives versus the supply of barrels, which we maybe get to in gas today. Mm-hmm. Are there just more crude sellers? Or is the producing community get spooked and say, okay, no more. I've been holding out for a better tomorrow, but I can't take anything less than 65. So sold.
Yeah.
Smushes these Cal strips down. Inherently, there's always going to be more barrels in year 2 than there is in year 3. Year 1 can be a different animal because there's just enough liquidity from the spec community. It's hard to see. But that relationship in the spreads, I think, is interesting.
Yeah. Yeah, it's kind of related to that is this bearish demand narrative that I think we've kind of had over the market for, I don't know, going on a year plus, year and a half. This, call for a recession at some point and kind of 2 years straight of, the recession is near kind of attitude. Kind of makes me wonder if that's just a little bit of a lagging narrative, not really paying attention to the latest way the data is shaping up. And as you mentioned earlier, with OPEC planning to bring production online, I think there's potentially some underappreciated
Maybe it's not as bad as people think. Yeah. The Atlanta Fed's latest GDP reading's not good. So there's that. There's the tariff sanction world that we live in. I don't know. I'm going to just say all bets are off.
Yeah.
Maybe if we do go into one, it doesn't last as long, or maybe we don't go into one at all.
Yeah.
I guess those would be my 2 guesses.
Yeah. So, tariff commentary, one of the non-Canada themes that I think is worth covering as well is the secondary tariffs on Venezuela. So 25% secondary tariff rate that the Trump administration announced for buyers of Venezuelan crude. Maybe if you want to talk about who's on the potential receiving end of that 25% duty.
I mean, it seems like number one is India. India, long-standing key off-taker for Venezuelan crude, even as recently as this past summer, asking the former administration for some permission to continue and or increase its import of Venezuelan crude, got permission to do so. And oh, by the way, India has also increased its, buying relationship with Russia, signed some long-term agreements to bring in more Russian crude. And you think about the proximity, it makes sense. You stare at a map, it takes about 2 seconds. If I'm Venezuela, or if I'm India, who am I buying crude from? Well, I could buy from the Middle East. Clearly, that's very close. But then I'm competing with a far bigger buyer, China, or I can look to Venezuela and Russia, or you've got barrels floating around near me too, and I'll take some of those. So the relationship with India is going to be an interesting one. You were telling me before we got on today, it looks like maybe there's a posturing that maybe will ultimately be a segue to some discussions on natural gas. But maybe recap real quick what the, proposal on the table is right now for India to kind of soften the stance.
Yeah, I think we're seeing quite a bit of this, especially from a lot of the kind of Asian region, Southeast Asia in particular, and India. But the tariff threat from the Trump administration, obviously, a lot of those markets are export centric. So a lot of goods coming from India and Vietnam and Thailand and Indonesia into the U.S. And so the tariff threat with that outsized or super imbalanced trade is just kind of akin to a large target from the Trump administration. So India came out in response to some of the negotiations with the U.S. and said, I think we're going to consider removing our tax on U.S. LNG imports. So currently, 2.5% plus another 0.25. So total about 2.75% on U.S. LNG. And they're saying potentially going to cut this to zero and increase our imports of U.S. LNG. I think that's kind of the common theme, is using U.S. energy exports as that method to reduce those trade surpluses against the United States and thereby remove the extent of that tariff target or reduce that surface area. So I think that we'll see quite a bit of that across Asia, and it'll be interesting to see if Europe follows suit as well. I think that they're kind of in a position where they want to posture and say, we're not going to, bow down to the Trump administration, and similar things from the potential PM in Canada with their elections coming up. Interesting commentary, big posture. I think it's important to recognize the relative importance of trade with the United States for each of these countries, where, Canada, about a third of their GDP is from trade with the U.S. versus about 1.5% of U.S. GDP from trade with Canada. So it's that type of relationship where it makes it a little bit difficult to.
So hold on, cover that one for me again. So a third of Canada's GDP
comes from trade
to exports to the U.S.
Trade with the U.S.
And then what was that 1.5% number?
That's the U.S. share of U.S. GDP from trade. Yeah. And same pattern with Mexico, same pattern with a lot of these countries in the EU and in Asia. Just totally outsized benefit for the exporter to the U.S. to benefit from the U.S. consumer economy. The U.S., the trade war would be problematic, but relatively inconsequential compared to the damage that it would do to these other countries. So I think it's interesting to see some of the posturing from EU and Canada versus a lot of these Asian markets just going straight to saying, we're going to increase our imports of U.S. energy supplies. You have Taiwan and Korea looking at, the Alaska LNG projects. I think that's definitely an interesting one. But going back to India and Venezuela, I think the other party to mention there is China. And combined with the 25% tariff, secondary tariff for the Venezuela crude, you also have the maximum pressure campaign on Iran, which is starting to stack up tankers in Malaysia because buyers are starting to be a little bit hesitant. You have the big Chinese national oil companies saying, we're not going to mess around with these kind of complicated sanctioned or tariff barrels and add complexity to our relationship with the U.S. and others, but then they send that to the teapot. So the small independent Chinese refineries are traditionally the ones that have been buying a lot of that sanctioned Iranian crude. Should that dry up, it'll be kind of interesting just to see where does China go after that. To Russia, continue buying the sanctioned barrels, and then, maybe any other secondary effects that are worth mentioning.
Hey, so one more while we're on the topic of tariffs. What's the latest on the April 2nd deadline that's upcoming?
Yeah, I think the biggest thing to pay attention with the April 2nd deadline is just the reciprocal tariff and what that actually means. It's, as I mentioned before, this totally imbalanced trade. The U.S. trade deficit has broken records for consecutive months, for the last, I think, 3 reporting periods from the U.S. So I think that is really the conversation, is the U.S. saying we are going to just match what everybody else does to our trade. So, India say, 10% on a vehicle import. We're just going to charge the same thing for any good that you want to export to the U.S. I think that's probably the one to watch, and how the trade officials in these other governments are reacting to that. So if they continue to say, hey, we're just going to charge high tariffs on U.S. goods, I think that's kind of unlikely. But that's really my take, is just watch the reciprocal tariff rate. Everything else for, as we mentioned, USMCA, rules of origin on energy goods for Mexico and Canada. My take is that those likely will continue to be exempt.
Well, equity markets this morning certainly seem like they've got next Wednesday's deadline in the crosshairs. Some poor performance this morning, not back to early March lows, but certainly going the wrong direction, or maybe in the right direction if you're championing the recession belief.
Yeah. You have a take on that? You have a thought on the tariffs?
No.
Yeah.
It's like a flip of a 5-sided coin. It's just, there are so many different relationships that are interwoven that I think you're, really getting the lid lifted on. Venezuela to India, India to us. We just covered in more detail than I think we have on any of our podcasts so far. The flow of Canadian energy to various places in the U.S. I guess my take is mass confusion. Yeah. And when people are confused, pick your topic. There's often a run for the hills. Charging forward into confusion is not the norm for humanity. So I think maybe that, I guess stick to my guns a little bit. If there is a negative economic impact, I believe that it won't be as long as many people predict that are of the belief that this is coming and then it's going to have major headwinds for all manner of financial products.
Yeah. I think there's going to be quite a few last minute commentary from both US and a lot of these exporters to the US. So probably the next week or so will be fast moving. The other one that I want to talk about today is the gas basis and some of the regional gas pricing in the US and how that's been performing through winter.
Let's stick with the diff topic. Perfect. And we'll move to a BTU instead of a barrel. The one that I think most in the market would be aware of, but maybe not even those appreciating how fast this has happened. So it's not new news at all that West Texas or southeastern New Mexico MMBTUs are worth zero. The oily producers in the Permian have, had this thorn in their side of what do I do with these MMBTUs that come along with these barrels I'm trying to make. Back in 2022, we saw diffs really blow out. In late 22, got to the OCC 22 contract settled at minus $3.60. There was a data point back in the end of 2018, which was even worse. And that was really like, I'm going to, this is a really important one. So in December of 18, and if you think about what happened, NYMEX or benchmark prices got absolutely destroyed in Q1 of 16. And it was a long, slow recovery. And all the while, a lot of assets changed hands from publics to privates. PE stepped up and bought a bunch of distressed assets. There was a lot of NYMEX hedging and not a lot of basis hedging. And in late 2018, the storage levels that we had, moving into withdrawal season were the lowest amount, I'm going to say on record. It's been lower than that, but relative to demand, it was the lowest, 3.2 TCF to start a winter. And all of a sudden we went from a, $2.75, $3 market up to almost $5 NYMEX. And at that point in time, basis went essentially to zero, minus 456 for the December 18 contract. So those were the two worst. Yep, for Waha. Sorry, thank you. I think I've been talking about West Texas and not even saying the name of the market. Okay, so, think about yourself. If you hedge NYMEX and let's say, $3 for December 18 at some point, and then all of a sudden this basis market starts, moving from minus $1.50 to minus $2 to minus $3. Oh no, I'm at zero now. And then it just kept going. There was no end to the selling as that contract reached expiry. And so it was a lesson learned, I believe, by the oil producer out there. I really have to manage both my benchmark and my basis exposure in conjunction, or I can find myself upside down. I think I did a good thing with a NYMEX hedged and really prevented myself from receiving $0. Because in a lot of ways, that's what the oil producer out there is seeking to achieve, is something non-zero. I don't want the gas to be a hit on my oil revenue. And, it's about as simple as it can get. And then fast forward to the present, and you've had that same relationship in Q1 where we've seen some significant changes in curve shape for the hub, and certainly, outright levels. April contract just rolled off. 395. That compares to the prior April, I think $1.58. So certainly some meaningful improvement. And while, we peeled back materially from trading, intraday near 475, but even daily closes 450 or better, $4 is still a pretty decent price level. And in that rally through Q1, what you often saw was for every penny that NYMEX went up, Waha would go down. And you really had a very stable Val 25 Waha strip at like plus $1.50. It's just where it was anchored. Every day there was another seller at Waha near $1.50. And then you get to just this past month, and the pressure has become incredible. And it makes me wonder a little bit if we're in this 2018-like environment where there were enough people that sold NYMEX, enough producers that sold NYMEX, but did not cover their Waha basis, because just in the past month, the April contract's gone from minus 338 to minus 490. And that is quite the dramatic move.
Yeah.
And then I'll kind of stay in the West, the Western gas markets in general, and Waha is kind of this like on the cusp, the vast majority of the gas from the Permian does make its way to the Gulf Coast. But some, a meaningful portion, let's just call it 2.5 BCF a day, moves westward. And I'll go to the far west first, and the SoCal Citygate market. Back in 22, 23, there were just some incredible moves in basis on the West Coast. I mean, the most notable, of course, being the Jan 23 contract, which rolled off at a $49.60 premium to Henry Hub. Makes a chart kind of broken. It's hard to see any near-term data points when you got something that goes that high. But you've seen all Western markets get hit pretty hard. For example, the balance of 25 back in mid to late January was under plus $1. It was bouncing around between, call it plus 80 cents and plus $1. And the balance of 25 right now is only a 13-cent premium to the hub. And then in the daily market, we've seen SoCal Citygate trade at a dollar discount to the hub. The very front of the curve does reflect that. April SoCal Citygate minus 84 cents. So this, really up until September, October of last year, significant premium in the market out there has now rapidly dissipated. Same is true in the Rockies. And then, what are the ripple effects? So, a Waha molecule heading to the Gulf Coast has weighed on Houston Ship Channel. Maybe it's the MMBTU, or maybe it's just the derivative. Mm-hmm. If the spread between Waha and Ship Channel is, $4 wide, there is a merchant, a shipper who can buy a Waha molecule and sell a Ship Channel molecule and lock in incredible margins on their transportation. And the amount that they're buying at Waha is dwarfed by the selling from the producers. And yet they show up with that same short interest at Houston Ship Channel, and there's just not the same number of buyers. You've got the Houston Ship Channel market that, let's see, the latest Ship Channel Val 25. It's actually not as bad as it was just a month ago. Now it hasn't improved much. It was minus 52 cents, is now minus 49. So it's just kind of hanging around that same level. But that downward pressure of Waha, I think, has a ripple effect in a lot of markets. Ship Channel back in the, right before Christmas was minus 36 cents for Val 25. So basis pressure, generally speaking, NYMEX strength has equaled basis pressure. It's true in Western Canada. The one area where it's not, and it will be a key market as we move from the spring shoulder season into midsummer, is the Southeast. Southeastern basis has stayed relatively strong. So we'll pick on the SONAT market. So SONAT for the balance of 25, and we'll do a little quick time machine exercise over the past several months here. Very steady. Late December, plus 35 cents, 25. Same time in January, plus 38. Same time in late February, plus 38. Currently, plus 32. So the southeastern U.S. markets are, I guess we're trading places a little bit. It was the West, and now that's Southeast, which is really an interesting one as we get to midsummer. Back to that comment made earlier, I think before we got on today, it's all hands on deck once you get to midsummer. And price elasticity potential, as you move, to the end of winter into the spring shoulder season is far greater. When overall demand is lower, I can choose what I'm using in a power plant more at will than I can at midsummer. So where those Southeast markets trade this summer, and then how that impacts salt storage behavior, I think is going to be really interesting.
Yeah, especially as we just retire more and more coal. I think that'll, add to a lot of that. One of the things that you mentioned before we hopped on, I think would be interesting to hear you kind of clarify, is the impact of the ABS deals and how that fits in here.
Yeah, so we talked about some of these dramatic moves in basis. The NYMEX curve has been pretty dramatic too. We've got the balance of 25 at 438. That is pretty flat to 26 at 436. And that, at one point in just the past couple of months, there was almost a 50-cent premium. So you flattened out 25, 26. But what you're bringing up, and I think is more interesting, is say Cal 28. So Cal 28, a tenor in which the consumer is rarely, if ever, going to be active. It's made its way from the fall lows just under 350 up to almost, I'll just call it 375. So 25-cent improvement. And here we are heading back to 350 for Cal 28. So the back of the curve has gotten weaker while the front of the curve has gone up, just magnifying that shift from steep contango to backwardation. And then where it gets really dramatic is out in these periods that are very thinly traded. And this is not, a new dynamic, but it's to point out that the back of the curve has not moved as the front has gone up more than anything. For instance, Cal 30, back last spring, that was a $4 market and it's currently 335. So why? Why is the back of the NYMEX natural gas curve, worth 70 cents less today than it was a year ago? There's this tendency for the market to suggest, oh, well, there must be some fundamental reason for that. There must be, too much supply coming or demand is being lost. The idea that anything that far out can be predicted in terms of supply and demand is rather comical. Mother Nature and the many seasons between now and then will have, orders of magnitude greater impact on what an MMBTU is worth in 2030 than, any guesses today. But the fun thing about it is you've got this story that's floating around that it's because of all of this LNG build out. The LNG build out is going to create this excess of liquefied molecules heading to these new demand markets. And somehow I have a little bit of a problem with that because the amount of demand potential, which you've covered in great detail, I think air conditioning, another 25% of India, we don't have that much LNG being built. And so it's really just to point out that it may not at all be any fundamental shift in what an MMBTU should be worth. It may simply be that the oversupply of derivatives is weighing on the back of this curve. Oversupply of derivatives, what is that? More sellers than buyers, really simplistically. Who are those sellers? You brought up the ABS, so the asset-backed security deals. When you are going to securitize a piece of your PDP stream, essentially just locking in like an annuity. I've got this fixed return over a 10-year period. I'm raising some cash now to do so. I got to go hedge up 10 years. And then what does that do to a thinly traded, long dated portion of a curve? Well, you got to find somebody that's willing to hold that. Who's the buyer that can hold that position until they can find someone to move it off to, or it's close enough to the now that you can, change how you're holding it seasonally or in monthly spreads. So where would you hold it? And logically, you would hold it at the replacement cost. And I think the $65 level gets thrown around a lot for the replacement cost for crude. And lo and behold, you've got the back of the crude curve. I don't know. Let's pick on the same Cal 30 crude. Cal 30 TI is these 5 minutes, $62.50. So below 65. Yeah. For gas, that reference point is 350. So it's kind of that same relationship. Somebody has to hold it with these ABS deals, and I can only hold it if I can put it in my book at a level that I believe is below the replacement cost. We know the demand is coming, and we know that the supply potential is there, but I can't be long a position that's above that level. In other words, the supply is going to show up, and I'm, long a derivative that, may have a one-way ticket lower.
Yeah.
So I guess, in summary, maybe it went on a bit there, but don't be wary of looking at a long dated portion of a gas or a crude curve and being told a story. Well, this is the fundamental reason why.
Right.
The fundamentals may be more for the paper than it is for the barrel or the MMBTU.
Yeah, I think that's especially true for the LNG story. I think that's the persistent theme that you come across in kind of the general market commentary is, we got this oversupply of LNG coming by 2027 between Qatar, US, Russia, kind of your big three contributing to that with planned projects or projects under construction. Qatar with the North Field expansion. So I don't know. It'll be interesting to see that play out. I think there's a lot of underappreciated sources of demand that really aren't captured in that. You have even stuff like China really pushing hard to get to LNG powered trucking, where they're converting their heavy duty transportation fleet from traditional petroleum derived fuels to super chilled. And I think there's a lot of cases like that. I think the vessels themselves are also moving to a lot of dual fuel configurations, so they can use LNG, they can use traditional marine fuel oil. So there's quite a few different sources of demand that maybe aren't really discussed. And as you mentioned, I think the demand growth in those developing markets, India is a perfect example, 1.45 billion people. And as you mentioned, the AC story, I think that was actually a great one from this week. You have last year, maybe 2 years ago, AC penetration. And so AC availability in India was about 5% of the population. And just to increase that to 20%, 25% is a very significant source of demand. And this year's IEA Global Energy Review showed that the space cooling was the largest driver of global electricity consumption growth. So I think we'll probably continue to see quite a bit of that when you have almost 6 billion people living in 9 of the 10 warmest countries by population weighted cooling degree days. So yeah, it'll be interesting to watch that for sure.
All right. I think we covered a lot today.
We covered a lot.
I'm exhausted.
Yeah. I think that's good. We'll wrap it up there, throw some charts, tables and stuff in the deck for what we talked about. And I'll catch you next week.
Sounds good. Thanks, Alex.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.